So you want to be a winning trader. Well, there's really only one way that you can get that done, and that is by building a system. You need a step-by-step rules-based approach, which is going to keep you out of bad trades and force you into only the A+ setups, while managing risk and everything else on the back end. If you want to find mastery, get funded, make profits, and build a career in trading, then you need to do this. And in this class, we are going to go through every element of a successful trading system. I'm going to break down what a system looks like. We're going to build one together, and then we're going to test it, validate it, and take a look at the results using a backtesting simulator. So first, before we get to the testing, before we get to the validating, we need to go through what each of the system elements are inside of a good trading strategy. Let's go. So there are 6 core elements inside of a trading system. We have foundations, risk management, technical analysis, trade management, rules and guidelines, and psychological considerations. It's the culmination of these 6 things built out that will create your trading system. And now I'm going to take you individually through each of these factors. We're going to talk through them in a little bit more depth, and we are going to build a system together that we can then go and test at the end. Let's get started with foundations. Now, the first thing we need to get clear with are these 3 things. What assets are we going to trade? What time of day will we be trading? And what does our daily routine look like? So the first consideration of traded assets. Now, an asset is simply the currency pair, commodity, index, or whatever else it is you're trading. If you trade Bitcoin, Ethereum, and XRP, you've got 3 assets on your list. If you trade Euro USD, GBP USD, and gold, you've got 3 assets on your list. However, if you are trading between 10 to 20 assets, or you have absolutely no guidelines as to the amount of assets and which assets you trade, then you are creating problems for yourself, in my opinion. I think it's much better to work with 3 to 5 assets than it is to work with massive amounts of different assets. You might think the more charts I look at, the more opportunity I've got, and it's true to a degree. But the problem you run into when you operate in this way is that you are never in the flow. You're never in the know with what a market is doing, right? You jump to it, you see if there's an opportunity. If there isn't, you jump away. But if you do this with 20, 30 different assets, well, you're never really going to be in line with one market for the long term. I think it's much more beneficial to get to know just a couple of assets, maybe between 3 and 5. And over time, you'll start to understand how they work, how they operate, how they move. And you'll have a good mental idea as to what the past price action looks like. Is it in an uptrend on the high time frames? Is it in a downtrend? Where are these key major levels where we could be expecting reversals? You build this insight by just working with one pair. You kind of become a master of a few as opposed to, not a master of many, right? So trading too many assets can create stress and overwhelm and make things a little bit harder than it needs to be. And really in trading, and you're going to see this repeated through the system, we want to build simplicity in every area. Now, when I'm trading, I actually like to trade correlated pairs surrounding the US dollar. So correlations are something you're going to have to consider. You need to decide if you want to trade correlated or uncorrelated assets. Correlated pairs surrounding the US dollar would be things like Euro USD, GBP USD, AUD USD, gold, USD CAD, basically anything that includes the US dollar. The reason I like this correlation is simply because then I can track the macroeconomics and technicals for the US dollar, and I've got a pretty good idea as to where these other assets will go, which keeps my trading very, very simple and allows me to pretty much just lock in and focus heavily on the US dollar. And then I can trade the other assets in line with the directions of the biases that I've built there. Obviously, correlations can have some weaknesses. If you've got 5 correlated pairs and you take a trade on all of them at the same time and it loses, well, you're probably going to lose 5 times because you were wrong about the dollar direction, right? So that's something to consider when building your asset list. Correlations can be good, but for some people, they prefer to avoid them. Now, inside of our system, the assets we're going to look at are going to be Euro USD, GBP USD, and XAU USD, which is gold versus the US dollar. And as a little side note, something you could focus on if you wanted to focus heavily on the US dollar index would be the DXY, which is basically a chart that shows the strength of the dollar weighted against all of the other currencies. So if the dollar index is bullish, you got an idea that the dollar is probably going to be going up against other currencies. If it's bearish, you got the idea that it's probably going down. This can be really useful, just as a side note, if you wanted to include something like that in your trading. So now let's take a look at trade timing, more important than you would imagine. If you are going to be day trading, timing on your trades is going to be very, very useful, probably rather essential. If you're swing trading, timing on trades doesn't matter so much, because with swing trades, you'll be taking trades at any time of day, looking to hold the trades for a day or more, maybe even over a week, which really means it doesn't matter what time you execute the position, providing the high time frames obviously give you the signal to get in. Low time frames or day trading though, it is more important, and here's why. We have 3 primary trading sessions every day, specifically in the currency markets. The Asia session, the London session, and the New York session. Now the Asia session takes place obviously in the daytime in the Asia Pacific region. So Asia, or Australia or New Zealand, this is daytime for you guys, right? So this is the time that if you are situated there in the world, this is when you'll be trading primarily. London session is obviously UK and Europe and Africa daytime. So if you're based anywhere there in the world, London session is probably where you want to trade. And New York session is obviously US, Canada, that time zone as well, right? You want to trade through New York session because this is the daytime where you are going to be trading. Now, why is it important to understand this? Well, what we want to think about is the assets we will be trading. If we are going to be trading through Asia session, currencies that are Europe and US focused, like Euro USD, move very much sideways. They don't really go anywhere. But if you focused on AUD, NZD, or JPY, they do go somewhere during Asia. So if you're situated there in the world and that's going to be your primary trading session, you need to make sure you're trading assets that actually have good odds of giving you good trades. GBP USD during Asia session is rarely ever going to give you a good position, but if you went and traded USD JPY or AUD JPY, well then you are going to get good momentum. Same goes for London. Some pairs will slow down in London session. It's generally one of the highest volume sessions, but if you are trading through London, you should focus on European and US based currencies. You can pretty much do the same for New York session as well, but it's just for Asia session you want to make sure you're avoiding trading these currencies because you'll be stuck in choppy moves. So the time of day that you execute trades at does actually matter, okay? Specifically for day trading, if you're getting in and out of trades in the day, you need to get real and get clear with the session that you're going to be trading. Now, inside of our system, we're going to keep it extremely simple. So we're actually going to focus in on swing trading, which means time of day won't matter so much to us. But if you're building a day trading system, then it certainly does. So now let's talk about daily routine. Each day, you should build a routine for your analysis, your trade management, your journaling, and your testing and study. If you can build out a routine that includes all of these aspects, you're pretty much covering all grounds of what you need to do in your trading. See, when you trade sporadically, when you trade randomly, you don't really get much done because you forget about doing things or you don't do things on time and everything's basically just a big mess. If you can routine and schedule your day into, number 1, some time in the morning for analysis and setting orders or executing trades. Number 2, management, just little time blocks to come in and manage your positions when they're executed. So moving stop losses, taking partial profits, whatever it is that may need to be done. Number 3, journaling, making sure you are tracking the trades. You just do this for 20 minutes at the end of each day. This is going to give you a bank of information, data, and knowledge that you can work with to become a better trader. And number 4, of course, testing and study. This, at the moment, is probably what you should spend the most time on, is actually testing things out, studying things, learning new things, and putting them into practice in simulation. So time for that each day is very, very valuable for pushing you forward as well. So this is something you should all include inside of your trading plan, and that pretty much concludes the foundations section, which means we can now move on to risk management. Risk management is exceptionally important because trading is a game of probabilities, and we know we are inevitably going to lose probably 50 or 40% of the trades that we take, even if our analysis is really good. So we need to make sure we've built in every aspect of risk management to provide us profits and make sure that we make money even when we are wrong and even when we have inevitable losing trades. So there are 3 aspects we're going to cover: risk per trade, risk to reward ratio, and win-loss ratios, starting with risk per trade. Now, the general rule is to build a positive asymmetric risk reward system, you need to operate with a set risk per trade on every single trade and do not deviate from that. What this is going to do is contain your losses and make your losses very consistent and very predictable, which is going to keep them in check. And will also make sure that your wins are also rather predictable in size as well. Now, I recommend a good risk per trade is 1%. This will allow you to make good profits on the trades that win, but it's small enough to make sure that if you do have losing trades, your losses aren't getting out of hand. They're still small and contained, and it would take you a hell of a lot of losses to get yourself down into a bad loss. So simple rule, just operate with 1% risk per trade. That's what we're going to do when we build out a system in a bit, and that's what I recommend to you. So the next thing is risk to reward. We want to create a positive asymmetric risk reward system, which basically means We want to make sure we are risking $1 to make $2 or more when we take a trade. Now, I really think the best risk reward you can push for is around 1 to 3, which means for every $1 you are risking, you've got the goal of returning $3 in profits. When you do this, you can take one winning trade and one losing trade, and you will walk away with 2% in profit. If you took 10 trades, 5 of them lost and 5 of them won, you would walk home with around 10% in profits. Now, obviously, the way that we actually achieve this risk reward comes down to the technical processes that we use, and we're going to get onto that in a bit. But the core focus is always going to be basically to win more on our winning trades than we lose on our losing trades. So that way, we can have 50%, 60%, or even 40 or 30% win rates, and we will be fine. So now let's talk about win-loss ratios. Now, realistically, we can't decide how many trades we win and lose because the market has unpredictability factored in. Even if you have the best trade ever, the analysis is literally perfect in every way. The macroeconomics line up with it, and everything tells you this is a A+ trade. There could still be just a random piece of headline news that kills your position, turns it into a loss, regardless of how good it is. So there's no real concern in putting too much weight on trying to get high win rates, like 70%, 80%, or 90%, because the market's going to do what the market wants to do. However, there are some baselines we can work to. The first is your win rate realistically should be a minimum of 30%, which means you're winning 3 out of 10 trades. Now, this is not optimal, but you can actually make good money doing this. So even if you are losing 7 out of 10 trades, you are going to be okay, and you can slowly improve that over time. I will say though, if your win rate is any lower than 3 out of 10 trades, there is something wrong with your system, okay? 30%, not hard to achieve. If you're losing more than that, well then there's fixes that need to be made. I personally believe that 50% win rates are attainable and should be the goal for you to push to over time. Yes, as you start off with the new system, you might make mistakes, but as long as you're tracking that and learning from that, you will be able to push towards 50 to 60% win rates for the long term once you've really got your system dialed in. Now, to recap my 2024 performance, this is a 60.71% win rate over the span of the year. And as you can see, the equity curve and profits actually never went down, except for the first trade of the year, which was a loss. So even though I'm losing 4 out of 10 trades, I'm actually still hyper profitable. And that comes down to the risk reward that we just discussed. My winning trades are bigger than my losing trades. So those are the risk elements we need to consider. Now let's talk technical analysis. Your technical analysis should be laid out in a systematic, rule-based manner. When you come to the markets each day, you want your trading to be systemized and routined and look like this. You analyze the market, see if a setup is present. If it isn't, you don't trade. If it is, you check other criteria like the time of day and whether there's any big economic news coming up. If it doesn't fit the other criteria, you don't take a trade. But if it does, then you take the position. When you operate in this way, you are taking only the highest probability trades, which means you are going to have the highest probability of making money. You're eliminating the crap. You're making sure the trades you take are the ones with the biggest odds of winning and the ones that are going to bring you the biggest returns. And it really simplifies your trading and removes the stress from it as well. There's no more discretion, there's no more guessing, there's no more gambling. You just follow a simple rule-based approach. The rule-based approach we're going to follow is going to be to analyze from the weekly and daily timeframes to get an idea for narrative and direction. Then we're going to mark up 4-hour supply and demand zones to identify opportunities in line with the direction that we've collected on the high timeframes. And we will use the 1-hour chart to actually execute buy or sell positions in line with that overall direction. So that's going to be an exceptionally simple system. We are just building narratives and zones on the high timeframes, then the medium timeframes, then the low timeframes, and executing in line with that. And what we're going to do is come to the markets and analyze in a fractal manner, which means basically what we're going to do is analyze with the same flow on the weekly that we then go and analyze on the daily, then the 4-hour, then the 1-hour, all the way down to executing a trade. And the things we're going to focus on are number 1, trend direction, number 2, imbalances, number 3, supply and demand, and then for our trade execution, we're going to use buy and sell limits, and we're going to target the high or the low of the previous move. Okay, you're going to see this in action soon. Do not worry, we're going to get to that and I'll show you how it works. So that's technical analysis. Basically, you just want a step-by-step of I'm going to do this, then this, then this, and then if this forms, I will take a trade. That's it. So it's kind of an if this, then that format for your trading. Just really, really simplifies the whole process. Now let's talk about trade management. So this is kind of a follow-on from technical analysis. This is still factoring in how you actually get into and get out of trades. But trade management comes down to things like contingency plans, which is basically, as we know trades are going to go bad sometimes, how are you going to manage that? How are you going to limit the downside? And there's 2 things we're going to talk about here: partial profits and stop trailing. To explain these, we're just going to quickly head over to the charts, and I'm going to show you what this looks like on the chart and how it works, and I'll tell you which one we're going to bring into our system. These are great methods to make sure that you don't turn winning trades into losing trades. Now, partial profit taking is all about taking profit at multiple levels. So for this example trade, we're going to go and target this low. We've got a random entry. We're just using it for example's sake. This is going to be our overall target. If you were using a partial profit system, you may say, I'm going to take half the profit here at this swing low. That way, if we get down to this level and then reverse, at least we've locked in a nice profit on half of the move up to this point. Now, this trade to here would be a 4% return. If you close half the trade, you would lock in plus 2% at this level. That way, if the market continued, you would make 7.9%, so around 8%. So you make 4% because you'd only have half of the move open by the time we got to here. So you're turning a 8% potential trade into 6% maximum. So you do slim down the profit potential, but it does mean if the market doesn't get all the way there, you're still locking something in, because if we get to here and flip, you've closed 2% in returns, all right? Stop loss trailing is the other way to do it, where if the market creates bearish structure, you move your stop loss to follow the structure of the move. That way, when the market flips on you and you get stopped out, you're actually closing the full move above the structural point. So if we were to close it there, that would be a 2.6% return, all right? Now we'll do the stop trailing as the market goes through. So let's get rid of these drawing tools, and then we will zip through price and see if there is stop loss management methods available for us from that approach. Here's how stop loss trailing looks. We have now pushed down, created a new lower high, and pushed down to a low again. So what we would do is we'd get the stop loss from here. We're going to indicate the stop loss with a red line, and we would put our stop loss here. Now we have minimum around 1%. If the trade flipped all the way back to here, we're not losing anymore. We're getting out with a 1% return. Yes, it's not the ideal scenario, but it's still a way that we are ensuring profitability. So here we've gone up, created a new low, and then we've come back down and pushed into these lows again. So what we could do in a stop trailing example would be move our stop loss to here. In the partial system, we have now closed 2%, and we're waiting for the market to hit this target to lock in the extra 4%, right? Well, as we can see, the market's now reversed on us and closed us up on our second trade, our stop loss management trade, 3.56% there. So we have 3.56% return on the stop loss trailing approach, and at the moment a 2% return on the partial profit. And our stop loss for the partial system, by the way, would now be to break even. So we either have 2% and the rest closes for no loss, or we have a 4% trade if it pushes down towards our target. So as you can see, it looks like the market's creeped back up towards the entry. On the partial system, you would have been stopped out here for 0% plus 2%, so you got a 2% return there. On the stop loss trailing, the whole trade was jammed out here at 3.56%. So you got a 3.5 return on the trailing method. Now, this is of course not going to be the same on every trade. Partials are going to be better on some. Stop loss trailing is going to be better on others. Now, I suggest to you, if you bring one of these approaches into your trading, you stick to one. If you try and juggle these, you're going to be in a tricky situation. You're going to get confused. So just stick to trailing, or just stick to partials. Or what we're going to do is actually just set and forget. So when we take trades, we're just going to get in and then leave them. All right, that's what we're going to do in our test because it's the most simplified, and I just want to show you a simple system. But these are two great contingency approaches you can use, and you should factor this in as a part of your system. All right, that's trade management covered. Now let's look at rules and guidelines. So rules and guidelines are simply safeguards that we put in place to limit mistakes and avoid getting into bad situations. A few rules and guidelines to consider are loss limits. These are basically rules that you'll put in place to make sure you don't lose more than you want to in a given time frame. So if you have 1 or 2 losing trades in a week, you could say, I'm going to stop after 2 losing trades in a week. Or if you have 4 losing trades in a month, you could say, I'm going to stop trading, realign myself with my systems through backtesting and reviewing my journal, come back next month. Basically, this is going to stop you from going on those terrible downward spirals where everything falls apart very, very quickly. The next rule is red folder news. This is things like this here. So interest rates, inflation, economic data that is high impact and will drive the market erratically. This stuff can kill even the best of trades because it creates a massive speculative spike when the data drops. So making sure you're not trading through red folder news is a very simple rule and guideline you can put in place. You can check an economic calendar like FX Street in the morning and make sure that you are not going to be trading through red folder news, and then just avoid it when it does come up. This is going to increase your win rates by cutting out those terrible, unpredictable movements that the market creates. And the next rule or guideline is profit caps. Now this one sounds very weird, to cap your profits. However, a lot of traders will make a lot of money and then give it all back at the end of the week. So if you work within a profit cap and say, okay, I'm going to go for 5% per month in returns, then what this does is as soon as you hit your 5% threshold, you can pause trading and make sure that is locked in. That is still upwards to 60% profit per year, which is an insane return. You're probably not going to get that, but you might. But while it does, of course, limit your profits, what it actually does is stops you from giving it all away by being greedy and taking subpar setups, trying to pull more out of the market endlessly. And another thing you can do in the way of profit caps is you could have a dynamic one. So if you are looking for a 5% monthly profit return, let's say you make 5%. Well, you could say, I'm going to use 1% to try and take more trades to open up the profits. But if I get to 4%, I will lock my profits for the month. This gives you pretty much one more bullet. If that trade goes well, you can continue trading with that profit. And this is how you hit those 10, 15, 20% months. But if it goes bad and you get pushed down to 4%, you just lock that profit in, and that's going to pay you a few $1,000s for the month. So profit caps aren't for everyone, but I do suggest you actually consider them because they are very, very useful for getting you over that hurdle of giving back all the profits that you've made due to greed and pushing too far. So that's rules and guidelines, just a few little things you can put in place. Now, obviously with our backtest, we probably won't be doing too much of this stuff because we are using simulations, but it's something we definitely can consider when we are trading live and something you should look at putting in your system as well. Now, the final factor is psychology. It is important to consider psychological implications inside of your system. So there's a few things we can do here to actually turn psychology into a systemized process. We can do a readiness check, mental journaling, and benefit from the clarity of our rules-based system. So let's talk about this readiness check real quick. Each morning before you come to the markets, you can fill out a template or a little note in your notebook saying, how ready am I to trade today? Did I sleep well? Am I feeling stressed? Are there any external factors that are going to mess up my trading? Prepping your mind in this way tells you whether it's a good idea to trade or a bad idea to trade. And then you can just take days off when you feel like you're not up to it. In trading, we are paid for the quality of our decisions. So if we're not in a good headspace, our decision quality is going to be low. We're probably going to pay the market instead of getting paid by the market. So a readiness check, super simple, very valuable thing to do. Now, the next thing is mental journaling. I believe that traders should journal all of the trades they take because there's lots of valuable information and data in there that you can build off of in the future. You can use this to reset your mind to align with your system when trading feels difficult and you've forgotten how to trade. You can use it to refine your systems and improve by looking over past trades and seeing patterns that win and patterns that lose, pushing on the strengths and cutting on the weaknesses. But you should also track not only the trades itself, but your mentality. This is a very useful thing to do. So let's say you create a little template for yourself, and at the end of each day, you track down the emotions you felt today, whether they caused any interference with your trades, and what that did to your results. When you do this, you're going to see that, for example, if you have hesitation problems, you hesitate out of good trades, even if they fit in your system. Well, with a clear idea of this and seeing that this is repeatedly happening, now you have an actionable thing to work on fixing. Because obviously, if you are messing up trades and you're losing out on money due to hesitation, you've got it at the forefront of your mind for the next day or week of trading to fix this problem. So just spending 5 to 10 minutes per day at the end of each day, tracking down your mentality, any emotions, any effect that had on your trading, this is going to give you actionable points to work with every day, every week to become a better trader. And the final thing is clarity of rules. What I mean here is that when we trade under a rule-based approach, we have more clarity, more confidence, and trading is a lot more stress-free. We eliminate a lot of the guesswork when we work within a rules-based system because we are just doing it if this, then this, then this, then this, right? It's an if this, then that style system, which means we don't have to do too much thinking. We just analyze and execute in line with that system. So just being clear with the clarity that a rules-based system brings you makes trading a lot more stress-free and a lot easier to repeatedly succeed at. So that's also worth considering. It's just a nice little mental note inside of your psychological systems as well. So that's everything covered. That's the psychology, the rules and guidelines, the trade management, the technical analysis, the risk management, and the foundations, all of the things that build up your trading system. Now what we're going to do is go over to a backtesting simulator, and we're going to test out the system that we've just built out together in a simplified format. I'm going to show you what it looks like in real market execution, and then we're going to backdate some of the results and see how the system performed. So this is going to show you what a system looks like and how you can start to build out your own. Let's get to it. Okay, so we're here on gold. We're going to backtest this just over a few months. We're doing a very small sample and then going to go and do Euro USD, GBP USD off screen because I don't want to turn this into like a 40-minute long backtest class. But we're going to then culminate the results and see what the system looked like. So we're starting on the weekly. We want to identify trends and zones. Okay, that's the format we're going to follow, pretty much time frame for time frame. This red candle here, I see as a nice demand zone. Possibility that if the market comes into here, we can continue buying because when we look at the high-low structure, you can endlessly see on this chart, we are in an uptrend. Okay, the market is continually pushing higher over and over again. So we know we're bullish and we know this is going to be a good place to potentially buy from. Now let's go to the daily time frame. We're not getting much in the way of information here. We still have the weekly demand to consider. Daily brings us a potential refinement down to this point. So what we could actually look for, now that we're seeing the market pushing into these lows, we've seen a demand fail here, will be some possibility to sell down towards this level, all right? Then we would continue buying because this is an uptrend. Now, 4 hour, nice and simple. Let's take a look here. Okay, 4 hours giving us a good picture as to another zone that we could focus on. We have here a break of structure into a new high. This comes from a zone here. So this would definitely be the first zone to look at for high time frame directions because this is the zone that broke structure, which basically what that means is this is where the last culmination of demand or buying pressure came in. We're talking about this point here, by the way, before the market was able to break through a previous high, which shows this point as an area that has a lot of strength behind it. All right. So a couple ideas then. We can look to sell down towards this point. If we see the market start shifting here, we can rejoin buys. We will also look for if the market does not shift there and it comes down to here, we would look for the same thing again, starting to break some structure, then we would join buys from there because we know the weekly daily is indeed bullish. Now, if we're going to look for sells down, we ideally want to see a demand fail here. The final imbalanced demand zone in this price move is going to be here. I used the last candle before the impulse. We can see the market has indeed pushed through this level. We've also pushed through the low. We've pushed into what we call an efficient range, which basically means the price action here has no demand in. It's not imbalanced. So this is definitely going to be a very clear target. If we want to do that, we want to look for a trade following the current 4 hour trend. It would be selling from this point. So we would look for the pullback into there and then a sell down towards this level. Now what we want to do, as we said, is go to hourly. We're just going to use the hourly in a simple format for this test. What we're going to do is make sure that it doesn't show any other areas of demand, which as we can see here, actually, we are seeing an area of demand, which tells me unless we are to push under this low. So if the hourly comes and pushes under this low, then pulling back and selling from there is good. If it just pushes up from here though, I probably will not sell this point, even if it does react, simply because there is now risk that we demand react and end up going higher straight away. So although I like the downside targets, we would need to see a close under this level or a push under this demand to actually validate the possibility of going down towards this hourly region. So let's see if that happens. Okay, we did get a close underneath demand, which shows us this demand has failed. Following our rule on the hourly, we're going to refine the entry into the last candle before impulse. So if we're going for a sell, we're going to be selling here. Stops above the zone, above the high, and then targets down into the next low was our standard rule here. However, we can extend this through to our target. So we're going to push it down to the next reasonable low. Okay. For this system, I think what we're going to do is basically trade towards high or low if that's the clearest opportunity. So a trade like this. The second thing we can do, if it's completely obvious though, is extend trades towards imbalanced areas of supply or demand, because this is a pretty standard way to trade. If you've got a clear target, you run it. If you don't, you target the low. Okay, so that's the way that we would approach our management or profit setting, target setting in this system. Cool, so that's going to be that. We're going to place this order. We're going 1% risk. So we're going to save that. The trade is now executed if the market fills that region. Now we just have to wait and see if the market comes up and hits that entry point. So let's run it forward a bit. Okay, looks like we've missed there. So we're probably not going to be getting that fill. What we could do following the hourly would be look to follow it like this. So we could move this order basically. We're going to remove it. We'll place a new one here. 1% risk again. And now we'll see if this gets filled. No, we have to delete this order because the demand zone is hit. And now what we're going to look for is we're going to go to the 4 hour and we are going to monitor if the market shifts. Okay, so we're looking for basically push back up over the high to confirm any possibility of upside. If we don't get that and we instead get a push down, then we will look for selling. Now, the reason we do not look for selling now is because we are in a demand zone. There's possibility of reversal here. So although we could look at pullback sell, that's going to be high risk because we're at a possible reversal point. All right. So we're starting to see some strength picking up in this market. We've seen a supply fail. Good news. What we would ideally now want to see is just the market start pushing over these highs, and then we can start looking for some buys. So there we have a push. That's very nice. In terms of executing a trade here, we definitely want to check out the 4 hour and 1 hour timeframes. So from a 4 hour perspective, I've got a pretty clear demand zone sitting here. This would be the one that I would be interested in. Again, a zone that broke structure. So we have the strength from the breakout behind the movement. As we said, we are confirming those zones on the hourly. So we want to check the hourly time frame. Hourly looks pretty good as to the same demand realistically. So what we could do here would be place an order, buying from there. We can put a stop under that low. Target, I mean, the obvious target's going to be the gap fill here. Because we're in an uptrend, yes, there is opportunity, possibility to go higher. We're going to look at this for now. If this is filled, we may end up working with whichever high the market prints. So if we pull back like this, I'm happy to take that. If we push up to here and then pull back, we would just use the high created as our target. So let's see how this goes. Okay, so it looks like we're going to be moving our target to here. This has created relative equal high liquidity as well. Something if you don't understand, don't worry about it, but that's going to give me context for the target. And then the trade would look something like this as of right now. Well, because we're uptrending, we can definitely keep looking to extend this a bit more. I wouldn't want to change the entry to here because of the large imbalance and open demand and liquidity relative equal as we've got below. So our trade target's actually just going to extend to there. Entry is going to stay the same as of right now. And you can see what we're doing here is building a rules-based approach, right? So we have basically analyzed direction, supply, demand, target. And then we do that from the weekly to the daily to the 4 hour. And then we use the 1 hour to refine our entry zone. You can see this trade's been executed now and it is in profit. So we're going to see how this goes and whether this fills through to where we want it to go. Now, as we said, trade management for this system is going to be hands-off because we are keeping it simple for explanation's sake and for example's sake in building your system. So we're not doing partial taking. We're not doing stop trailing. You can if you want to in your system yourself, but for this, we're keeping it simple. That's one trade one, which is good news. We are also now in an uptrend and we want to identify the next possible point to buy from. Now, we are looking for refined extreme demand zones. This one's been retested. This one's been retested. So the next point that we could look at from an hourly perspective would be this candle just beneath the market gap that was created. This is basically the furthest point from price currently inside of the current movement that still has imbalance into it. All right. So that would be the next execution we can look for. And basically what we're looking to do here is continue this market going higher. We look at the weekly. We know it's bullish, right? We have the weekly bullish uptrend of continual higher highs and higher lows. We came into the weekly demand. The daily, we missed the demand, but we hit this 4 hour refined demand. Then we waited for a change in the structure. Then we executed on a pullback. Now we've waited for a break of structure again. We're executing on the pullback. So I'm going to go ahead and place an entry, but we may be dynamic with the target because of course we're going to kind of line it up towards the highs. So targets wise for now, let's just say we push it towards the supply zone up there. And then we can amend it to meet price wherever that may be. Save that. But really, we're looking for gold to go and make some new all-time highs in this uptrend, considering we're now pushing up towards those levels. So we can extend our target just slightly based on the price action we just had. We can push it up to there. Okay. See if we get the fill. We have the fill. We filled the final imbalance demand zone now, so we should move higher. If we move lower, that's going to break the trend and give us a change in direction of the market, which would allow us to then go short instead. Right, that is the next push. So now we can do the same thing again because we've created a new high, okay? What we've done is we've pushed up, created a new high. We want to find the last imbalance point in this range. There's one all the way down here, but this is not one that has any significance really because of the efficiency of the range. This one has created a large push, which has broken us out of this range and pushed us into equal highs up there, or just slightly higher highs inside the internal structure. So this is going to be where I want to work with. We're going to enter there. We can put a stop under this next low. That way, if there is a wick down, we're still safe. Targets wise, we just go back into the highs again, okay? So that would be a nice trade too. Now we're going to see how this one goes. We can extend this target ever so slightly too. Bring that up to there. And then we see we get a fill and then a continuation higher. So this is a slow mover. Let's move it a little bit faster. Okay, that trade has lost, which essentially changes the trend direction. Okay, so our execution looks like this, meaning we are left with 3 positions. We have 2 wins here. Number 1, number 2, very simple trend following trades. Number 3 off the next hourly demand was a loss. So we have 2 wins and 1 loss. And now we really want to see these lows break completely before it opened doors to any further downside. So that's pretty much the end of the timing we've got. That brings us to the modern day. So let's go and take a look at these analytics. But first of all, I'm going to add a little bit more testing on GU and EU over the same time period. Right, so I added on some testing on GBP USD over a bit of a longer time frame. We're going to go through now GBP USD and gold following this same system and see what the results look like over pretty much a 6-month period here, okay? With a $200,000 account, we are looking at a $38,425 profit over that pretty much half year of trading. The account balance says 438. You can ignore that. The reason it says that is because it's 2 $200,000 accounts. But the profit returned basically on $200,000 is $38,000, which is a 58.3% win rate, 13 trades taken, 7 won, 5 lost, and 1 break-even trade, as well as a couple of missed trades like the one we saw on gold. Now, what we're looking for when we're reviewing analytics of a system that we've built and tested is the average risk reward, the overall return, the win rate, and then we want to look at something at the bottom, which I'll talk about in a moment. But we can see here, 58% win rate, that's fine, that's in that 50 to 60% bracket. Average risk reward is 3.03, so pretty much bang on that 1 to 3 RR that we look for, making 3 times more on our wins than we lose on our losses. And what that does is drive the profits up very nicely like this. So you see, this is a losing phase. Then we have a big push to the upside. Then we have a small losing phase. Then we have a big push to the upside. So when the losses are taking place, the account is really not hit that bad. When the wins come in, that really drives us into new heights. As you can see here, pushing from 22 to 42,000 in just a few trades time, right? So when you have your risk reward set up like this, your downswings are very small, your upswings are very big. So 3 average risk reward, very good. 58% win rate, very good. You can see information here as to how long winning trades and losing trades take, but I want to take you straight down to here. We can see January, February, April, May, and June, all positive months. March, nothing went down in March, I believe. So between here and here, yeah, all of March, we didn't actually take any trades. We had a loss in Feb, and then just flatlined in March. Yeah, so we lost just ahead of March and then we didn't go anywhere. So you can see that basically each of the months we did trade were profitable. Then the flat month was nothing happened. But the overall return is pretty good here, right? We're seeing pretty good stuff from the performance of this system. Now, the one thing I want to show you is the Monte Carlo simulation. What this is a system that allows us to test out basically how long or how well the system is going to perform over a longer time horizon. So we're going to start off exactly where we leave off. We've got the average loss at 1%. We've got the average win at 3%, just a little bit more than 3% here, I believe. And then the win rate. So we're going to put this to actually 3R. And then our win rate is 58.33, right? Now, if we simulate this over 100 trades, we can see from where we are now, every single one of these simulations comes out positive. This is exactly what we want to see. This tells us if we continue to apply this system in the same manner for the long term, there is no way that we lose, okay? The only way we would lose is if we break or change the system. If we trade it as it is, as we have been, we will win. Now, obviously, we can use this to see how high our win rates need to be. If we take a look at this with a 30% win rate, well, with this risk reward and this win rate, we wouldn't do too well, right? We would potentially win. Most of the times we'd win, but there is possibility for us to break even, flatline, or lose, okay? Even then, we're still above the start balance of 200,000, but we really don't want to take 100 trades to make $20,000 in profits here. That's only 10%. If we had a 40% win rate, you're going to see that we are profitable, I believe. Yes, so every one of these profitable from the start point. Minimum extra return is around $40,000. Obviously, the best baseline is going to be very, very high. But this tells us really, if we trade this system, we want to keep our win rates around 50%. So we want to make sure we've got enough data to tell us that we can consistently achieve 50 to 58%, which is what we actually achieved. That will make us profitable. But the core thing we want to see when building and testing a system is the estimates of, if we keep doing what we're doing now with the exact data we've collected from our test, is the strategy going to keep moving upwards? Is the equity curve going to be continually bullish? Because that is what matters, and that is where the money is made. So the backtesting software we've just used is called FX Replay. If you want to use that yourself, there'll be a link somewhere in the description for it. Really, really good place to test. A really good place to see the results of your tests, and a really good place to, of course, estimate the long-term performance of your trades as well. But that's really how we build a system. So by now you're starting to see the value of building out a system, how important this is, and how much it can change the game for your trading. When you test a system in this manner, you get to see whether it works. And if it does, great, you can start to apply it profitably, and you'll have built a lot of experience in putting this system in action in the markets through your simulations. If you see that your system doesn't work, well, you've got lots of data to work with. You can see exactly what points you need to refine, and then you can work on doing that until you have profitability from your approach at trading. Now, my guess is you probably haven't done any of this. If you have done some of this, then that's great. Keep doing it, keep working towards it, and make sure you stick to it, because if you consistently do this, you will build out a system. But if you haven't, this is going to be the big step that you need to take. Building out a rules-based system using those 6 foundations we discussed, and then putting it into action through backtesting, using a trading simulator to actually build results, build experience, and collect data to see how your system performs for further refinement or validation that you are ready to start trading live. So your mindset is reshaped, and you have a system built out, or at least the first steps that you need to take in order to put a system together. There is one last thing we need to do, and that is to show you the exact 4-step process that you need to follow if you want to win. This is going to keep you on track, stop you deviating, and stop you falling off and losing your way. And in the next video, dropping on the 27th of August, we're going to break down the 4-step process that will take you to profitability faster than you could imagine. Put on notifications and join the email list using the link at the top of the description. I am going to send you lessons every day from here until then, which are going to expand on everything we've covered so far and set you up to put this 4-step plan into action in the best possible way. You are so close to achieving profitability in trading. There's just one more thing we need to do, and we're going to do it together in just a few days. So join that list, you'll get extra lessons from me, and I'll see you on the 27th.